Hello, Leeb Group viewers. Today is Friday, March 26th. The year is 2010, and I'm going to talk a little bit about the U.S. Treasury bonds. So Wednesday was an unusual day in the global bond and currency market. Anxiety about sovereign debt in Europe, particularly Greece and Portugal, returned after a brief absence. This fueled a strong rise in the safe haven U.S. dollar versus the troubled euro. But prices of U.S. Treasury securities were sharply lower. Benchmark 10-year Treasury had their worst day in 8 months on the same day the dollar had its biggest gain in 2 months. For some time now, what has been good for the dollar has also been good for Treasury issues. Both usually benefit from any flight to safety by investors. This time, though, the Treasury weakness came because of jitters about the ballooning supply of U.S. government debt. There have long been considerable talk and worry about the potential negative impact of rising U.S. debt on our government bonds, but Wednesday was one of the few clear-cut signs so far that the anxiety was showing up in the bond market. The Treasury market was hit by a wave of selling following sluggish demand for $86 billion of new issuance of 2-year notes and 5-year notes. Treasury prices tumbled, pushing the yield on the 10-year T-note to 3.83%, its highest level since the first trading day of the year. The big move down in Treasury issues made the dollar's strength all the more notable, and vice versa. The U.S. debt situation increasingly will weigh on the value of Treasury securities, especially long-term bonds. In our view, while everyone seemingly recognizes the need to start acting to close the deficit, nothing has happened yet. As hard as that's to believe, saying, quote, "we must do something," is no longer enough. So thanks for dropping by, and we'll see you on Monday.